Clutch Cargo's question is, what percentage of a portfolio should be non-US market index funds? Should you favor some countries over others? Developed economies only? That is a phenomenal question, and one I would argue that is more relevant than ever before. Why is it relevant? First, international investing, despite its importance, is very unpopular, especially for people living in the United States. Why is that? Because people are leaning into recency bias. This past decade has been phenomenal for US investors. People who have put all their money in the S&P 500 have made a killing compared to the rest of the world. But, as we also know, good times don't last forever. Additionally, past performance doesn't guarantee future performance. That saying is probably overused by the investing industry. It's been said so many times that people have kind of blotted it out of their mind, but it's also very true. It's also very important. Past performance is just like past lottery numbers. It tells you nothing about the future. If you're picking your lottery numbers based on the past winning numbers, you're not increasing your odds at all. What matters is what comes up in the future. Now, when it comes to investing, for domestic versus international, generally speaking, you should mimic the market. I invest 55% in the United States, 45% in the rest of the world using total market indexes. I'm just trying to copy what the world is like. Now, there are some considerations here and there, depending on your country, regarding taxes. Some countries favor domestic stocks more favorably from a tax perspective than international. In the United States, though, most of your investments will be tax sheltered. The largest investing accounts most people will end up with is going to be a 401k followed by an IRA, period. Now, let's look at it not from the tax perspective and instead look at it from the what countries should we favor. If you deviate from this global perspective, roughly a 55-45 US versus 45 international, you're making an active bet. Many investors favor their home country a little bit, but the information in terms of performance, not taxes, but performance, makes that a little bit sketchy. There is some validation, there is some truth though that investing in a domestic market is cheaper than international investment. If you're in the United States though, that doesn't hold up anymore. VXUS, the total international stock market ETF from Vanguard, is just 7 basis points. The domestic version of it, the total stock market, is 3 basis points. Both of them being under 20 basis points for the expense ratio, also known as 0.2%. Both of them, in my book, qualify as very, very cheap. Though less developed markets like Canada or United Kingdom might not have access to such low-cost funds. If you decide to deviate from the world's average, you are making a bet on a country. So if I add in an emerging markets ETF or allocate more money to emerging markets companies, I'm betting that it'll do better in the long run. But that's simply not guaranteed, and that additional time I spent researching what parts of the world I should be investing in and tilting towards, likewise, the fact that I'm investing in a more narrow focus, that likely means higher fees. The more narrow your investment option is, the more specialized it is, the more money it typically costs. All of that will detract from the portfolio. In my opinion, keep it simple. Just mimic the world's average, 55% US, 45% international, though make sure to take into account taxes and fees. And then when it comes to where you can really make money as an individual, go beyond with your time and maybe a little bit of investment as well into a more private enterprise trying to get alpha, outperform the average of the stock market. It's not the stock market. It's investing in yourself, getting better education so you can get a higher paying job. It's working overtime at your current job so you make time and a half. It is going to be starting a side hustle so you're not competing with giant companies across the world and investment professionals, but instead you're competing with local markets or local entrepreneurs at the farmers market to make a few extra bucks. When it comes to stock market investing, in my opinion, go with a low cost average, take into account fees and taxes, and then funnel all that excitement about making more money, that energy, into endeavors where the competition is a lot less than professional investors.